You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
What's great about chart art, which is what I call it, and my three favorite, I'm going to make them do it quick because these guys get so geeky and they get lost in things. But what's interesting to me about technical, because we're going to get a little granular for 40 minutes, and I'm conscious of time and lunch, everybody, so don't worry. But what makes technical so interesting to me is it's so poorly branded, technical analysis. Like the worst enemy of technical analysts is the branding. And so I like to call it chart art. You'll hear us talk about price. Price pays, price matters. And you hear these words in the industry called big data and small data. Price is the most amazing thing because it's both small data, because price is just one thing, it's small data, but price is derived from millions of data points, meaning all this big data gives you price. And so, for people that dismiss price away and go, that's not complicated enough for me, understand that price is one of the most complicated and beautiful things because of how small and how big it is at the same time. So I'm going to welcome up on the stage, and they're going to walk through how they think about the markets and how they think about ideas. All of them very different, top down, bottom up. JC, All-Star Charts, Chris Kimble, and they've all been here forever, and Charlie Bilello. And what you'll get a treat of is if you follow these guys, the idea of this peloton that I talk about is like, I have my own style. I like to own Amazon and talk about it, and I try and keep myself in these long-term companies. But when I get an email from Chris Kimble, I open it because it could be an idea that I'm willing to try, because I know Chris will not just get me into the idea, he'll tell me when he's wrong or when he's right, and he's getting out of the idea. And so in our business, it's not important to just hear ideas, it's important to hear when they close their ideas. All right, so come on up, guys. Is the internet working for you? You think you're good? Okay, so welcome these guys. I'm going to keep you on a tight rope. But pretty much, I'm hoping you guys like them as much as I do. All right, so who's going to start? JC?
Yeah, sure.
I think Joe had me.
Joe had Kimble?
Just ask Joe.
Kimble.
Joe's the boss. Joe?
All right, so let's keep it moving. We got for 35 minutes. All right, thanks, guys.
We'll try to make this short and sweet. My name is Chris Kimble of Kimble Charting Solutions, and it's a real honor to be here and see a lot of friendly faces and people that we communicate. Look forward to talking with some of you later. One of the things that we really like to do at our shop is look at very long-term perspectives to try to help people with actually short-term moves. So we'll kind of get into that. So today we're going to talk about potentially how one of the more influential markets to every one of us in our lives, whether you're trading it or not, that the bear market could be ending in that asset. We're going to discuss lookalike patterns. We're going to talk about how a major market is in a really tight jam and a breakout or a breakdown could take place, and also that a key market could be setting up a pattern for a 100% measured move rally. And again, I just want to kind of talk about is none of the three of us make these chart patterns. They're just made by billions of free-thinking people around the world. So let's get into it. And we want to talk about a potential reversal. This is a picture of crude oil going back over the last 30 years. And my question would be is, could prices of the past have an influence of the future to tell us where to be trading, of today? So one of the things that stuck out to us, this is a monthly closing only chart. So we're looking for what we want to call, when you put a happy face on a text message or something, that's an emoticon. But I want to think and kind of try to talk to each of you about that these are key emotive points. I don't want to say I have any idea why they become emotive points. I went to college in the 70s and I only had one brain cell, so you can imagine what I did to it, back then. So we're a pretty simple shop. But if you'll notice, is there a reason that crude oil stopped on a dime here? Or if we want to take a few of these Emoto points going back to the early 80s. So this is a close-only chart. So let's take the same chart and convert it to weekly. So now we're going to go from a 30,000-foot view and start drilling down to look a little bit more minor. So here's the same chart, but a high-low close, same pattern. You can see in the lower right, there's potentially a large bearish wick taking place. But what I want to look about is whether you trade crude oil. In my opinion, it's one of the most influential or important commodities on the planet. And if you had told me 20, 30 years ago that we would have as many reserves in oil in the Dakotas as in Saudi Arabia, I would have found it very hard to believe. So most in this room most likely could feel we have plenty of inventory. Is that fair to say, in crude oil? But could this be a reversal pattern taking place? Could this be potentially a left shoulder ahead at the crossroads of these two 30-year support lines? And so this is why I say it's not proven, but ironically, when Stocktoberfest is meeting right now, I think is one of the most important price times. This is my 36th year in the business, and I think from a price perspective, Josh brought up trends. This is a huge one to see if a trend reversal could be taking place. So as we look closer here, here's crude oil. Now we're drilling down even closer. Is this potentially on a weekly chart an inverse head and shoulders? The big test right now is if this is true, this is the neckline. So the neckline would come in still as resistance, so the market has to try to prove to break this. But is this the only place in the energy space that this pattern is taking place in? And the answer would be no. Here's XOP, the gas and oil exploration ETF. It's at a neckline test. We're seeing XLE in the upper right. We've got a neckline test. And we have the same thing with emerging markets, and all of us know that many emerging countries are laden with commodities, and so crude oil would influence them quite a bit. So we have a uniformity of tests taking place right now on potential reversals. When you look back over the last 5 years, this sector is one of the poorer performing sectors. So from a macro perspective, is the world trying to turn around here? And what gets us is these necklines are coming into play as resistance. So what takes place as resistance could have a big impact on other markets. So when we look at lookalike patterns, this chart overlays crude oil and the New York Stock Exchange for the last decade. And you'll notice that there's a fair, decent amount of correlation. Then you start to see a spread in the upper right. And so this was 2014 when we all know that the big decline started. So there was a big non-correlation that the NYSE held up fairly well while crude oil was losing roughly 2/3 of its value. But now look in the blue shaded area, how both of these patterns look very much the same. They're very much a look-alike, and a big test is taking place. So here's the big jam. This is the S&P on a monthly basis, and these lines are put in on a monthly close. So when we say that we're in a tight jam based upon monthly closes, the S&P, the trend is up, it's above its 200-day moving average. This is a huge breakout test of an upward trend. This is a jam that there's very little room for buyers or sellers. So a breakout could really attract a lot of buyers in the S&P. A breakdown could be, the opposite. So from a rally perspective, we're going to now go back to the first chart on crude oil and look back over 30-some years, and you'll see these kind of bands that crude oil is traded in. So here's the discussed potential trend reversal. And here's the pattern that, to me, is really big to all of our lives, whether you're short or long, whether you're trading crude oil or not, is what could take place here at the neckline. So traditionally, so far, this looks almost fairly textbook of a pattern. We went from 100 and some a barrel down to 25. We hit these long-term support lines. But right now, the measured move in an inverse head and shoulders, you're going to take the distance from the neckline to the head. What if? And it's still a huge if. What are the world's traders going to do? What if this is a neckline and you have a breakout? So you would take the distance of the head to the neckline and you'd lay it on top. And how ironic that that measured move takes it right to the next band of the 30-year at about $100 a barrel. So the correlation is high. Necklines are in place, long-term trend reversals. We all know that the world is trying to, the central banks flood the world with some monies. To me, this is the big test. No matter what you trade, if you're long or short, what takes place here at this neckline is really important. So in wrapping it up, there's a chance that one of the major markets for all of us in the world is reversing its trend. The lookalikes of the correlation is extremely high between the NYSE and crude oil. It's in a jam, and there's a chance that if the neckline breaks, the measured move would call for a 100% rally in crude oil. So when you think of those ETFs that we looked at, XLE could do well, XOP, EEM, and USO if this pattern is correct. But for all of us, why I think this is one of the most important inflection points is what happens if the neckline is resistance and it holds? What would the pattern suggest? We're in a 3-year trend down in oil. So this is, to me, one of the most important price points that we've seen in quite a while. So I'm going to wrap up. We're trying to keep this moving going. In each of your packets, we put a little flyer that somewhere is buried in my pocket. But for our services, if you go to KimbleChartingSolutions.com, we're going to offer, if you use the code Stocktoberfest, 75% off any of our monthly research product cost, for attending. So I'll turn it over to the next speaker. Thank you very much. This was in each of your packets. Thank you.
Hey guys, can you guys hear me all right? Is this thing working? I'm really loud anyway. So this is a huge honor for me. This is actually the 5th time I've spoken at Stocktoberfest. And every time I've tried to kind of share something new that perhaps I hadn't talked about in the past, but I'm really a keep it simple, stupid kind of guy. I don't think there's really any reason to overcomplicate things. So I figured I'm going to talk about the charts I talked about last year and then how those turned out and what they look like now and kind of go from there. So if you guys have any questions at all, I'm going to fly through this. I actually have a TV in the other room that's logged on to the research platform, and feel free to go in there, play around with it, and any questions that you have, you know where to find me, I'll be around. So anything we talk about here, guys, this to make my attorneys happy. This is only for informational purposes, obviously. These aren't any sort of solicitations to buy or sell any securities or invest in any hedge funds that I'm managing. Everything from here on in is strictly for informational purposes. Talk to your advisors and accountants and everything before you do anything. All right, so let's rock and roll. So last year I presented this chart. This is what the S&P 500 looked like at Stocktoberfest last year. And just very simple math, the market respects the 61.8% extension of prior moves. So we can talk about it later, come find me, but at the end of the day, since last May, there was no reason to be long the S&P 500, and from a structural perspective, it was a fade all day long. So looking at it closer, this is a closer look at what the S&P 500 looked like in October of last year, and as you can see, we had about 6 to 8 months of consolidation around these levels, very, very tight, and that resolved lower. So that is the market suggesting to us that at these levels in the S&P 500, where we were last October, there are more sellers than buyers above head. So it wasn't the market that we want to be buying dips, it was the market that we want to be selling into any rips, and we were looking for a retest of those August lows, right? So that's the trade. Fade the S&P 500, cover your shorts at the August lows. So obviously we all know what happened. The S&P 500 faded when it got into that overhead supply, right? Because it doesn't matter. All we hear all the time in financial media is why this, why this, why this, why this. They don't know. They're literally just making it up. The only thing that we're concerned with is the fact that it is clear that there are more sellers than buyers at a given level. And once that changes and the market suggests to us that that is now the opposite, then we will act accordingly. So let's fast forward. So now we're in February of 2016, earlier this year. The market not only got to our downside target where we wanted to cover all our shorts in the stock market, but started to consolidate, right? The demand really started coming in. That's what we call accumulation. Why was there accumulation at those levels? We don't know, and quite frankly, we don't care. But the simple fact of the matter was that simply was the case. And when the market retested those January lows in February, momentum put in a higher low. And that's what we call a bullish momentum divergence. The trade was very simple. We're long all day as long as we're above the August lows. That was the trade, very simple. In addition to the price and momentum diverging positively, we also saw the internals of the market also diverging positively. So remember, we talk about the stock market like the S&P 500 and the Dow, like they're like this magical thing or whatever, but at the end of the day, what they are a basket of stocks. So we look at the market not as a stock market, but as a market of stocks. So if the market is making new lows, right, and we are in a downtrend, you want to see an acceleration of the amount of stocks on the New York Stock Exchange also making new 52-week lows, right? So essentially, the internals of the market confirming what the indexes are actually doing, right? So when the stock market made a new low in January of this year, we got an expansion of stocks on the New York Stock Exchange making new 52-week lows, essentially confirming that, yes, in fact, we are still in a downtrend. Now, in February, the S&P 500 made a lower low, but notice how the amount of stocks on the New York Stock Exchange making new lows was essentially cut in half. So the majority of the stock market, by the time the February lows came around, had already bottomed. And I go look at this exact same chart in 2008 and 2009, when the S&P 500 made its generational low, theoretically, in March of 2009, the majority of stocks had already bottomed in October. The actual low of the market internals was in October of 2008, not in March of 2009. So it's a great leading indicator, obviously. So everything is suggesting get long. The internals are good, momentum has improved, everything across the board. Now we look at the little guys, right? So this is the Russell 2000. These are the small cap stocks in February of 2016. Again, made a lower low, momentum put in a higher low. So now the little guys, the more speculative, the riskier stocks, are suggesting the same thing, get long and strong. Meanwhile, the worst market on planet Earth has been the emerging market space. Anybody who's been in there the last 5 years has gotten absolutely decimated, right? So when you talk about the worst stock market and the worst stocks on Earth not putting in a higher low, so up here we have emerging markets going back a couple of years, and here's the S&P 500 going back a couple of years. Notice how in February of this year, the S&P 500 made a new lower low, as we just saw. Emerging markets put in a higher low. So we're seeing bullish momentum divergences, the internals are improving, and now the worst stocks in the world are actually diverging positively. Everything is saying get aggressively long, cover shorts, et cetera, et cetera. Think about what stocks have exposure in emerging markets, right? That global growth, the metals, the mining space. Up at the top, we have the Metals and Mining Exchange Traded Fund, XME. Down below is the S&P 500. Notice how when the S&P was making new lows in February, by the way, so is Europe and so is Japan, the metals and mining space was nowhere near making new lows, showing an incredible amount of relative strength. And when we talk about what moves markets, it's not me or you guys, it's the buy-side money that wakes up on Monday and has to put a couple $2 billion to work. That's who moves markets. And what they're looking at are two things. They're looking at relative strength and they're looking at momentum. They have different formulas and things like that to point them in the right direction and to quantify that momentum and relative strength. But at the end of the day, that's what they're looking for. So if we know that the biggest money in the world is looking for momentum and relative strength, I think it would be irresponsible of us not to, right? So here's the S&P 500 today. I think the line in the sand is very clear. The market peaked in May of 2015. As long as we're above those May 2015 highs, we got to be long S&Ps. If we're below that, then we'll reevaluate the circumstances. But if we are making, when you write down a list of bearish characteristics, right? Think about all of the bearish things you could possibly think of where you would be like, oh yeah, that's not good. All-time highs is not on that list. Here's a Russell 3000. This represents approximately 98% of all investable assets in the US equities market, and same as the S&P 500, if we're above the May 2015 highs, we have to be long the market, and we have to be erring on the long side, not being bearish, the world's gonna end because Trump's president, or any of this other nonsense that you listen. Price is suggesting that we are in a healthy market environment. This is the S&P 1500, which includes not just the S&P 500, but expands further. Same exact thing. May of 2015, if we're above those highs, we have to be long. There's no reason to be bearish. I mean, you don't have to be long, but I don't think there's any reason to be bearish if we are above those highs. Now within, so we take a top-down approach, right? So, as Kimble was saying, we look at things bigger picture, and, I guess we're trained in similar ways because I do the exact same thing. I start from a much global, longer-term view, and then I work my way down to both the intermediate term as well as individual sectors, right? So here we're looking at the Dow Jones Transportation Average, speaking of horrible investments over the last few years, and this is, when you think about emerging markets that were the garbage of the stock market the last several years, in the US stock market, the garbage has been transportation stocks. And notice how when the S&P 500 and Dow and Europe and Japan were all making new lows into February, the transports had already bottomed in January, showing us that relative strength, showing us that leadership. Not to mention, as the S&P 500 was still making new highs into May of 2015, these suckers peaked in 2014. So we look for transports as a leadership, both to the upside and to the downside. Within the Dow Jones Transportation Average, by the way, I like the Dow Jones Transportation Average. I think trannies go back up and retest those 2014 highs. And within that space, the railroads, in my opinion, look the best. This is the Dow Jones Railroad Average. This, to me, looks like a textbook bottom. As long as we're above this neckline, right around 1,200 and change, I think we need to be long the railroads. Unfortunately, there is no railroad ETF yet. So we have to make our own ETF and maybe either invest in a few of the railroads or a basket of them, or maybe just our favorite one. I like CSX. I think it looks great. As long as we're above this 29 and change level, I think it's a long, and I think we go up to the high 30s. Same thing with Norfolk Southern. Are you noticing how these trends kind of essentially look exactly the same? I think in Norfolk Southern, if we're above $100, I think we got to be long. I think we got another 20, 30 points to the upside. Looking internationally, this is the FTSE 100. Everybody talks about Brexit and all this stuff, and that's great if you're in the business of selling ads to consumers, but if you're in the business of making money, we don't care about any of that stuff. We're looking at the London FTSE 100, which is basically, let's call it, the Dow Jones Industrial Average of the UK, and here we are at all-time highs. These were the highs in 99, 2000, the highs in 2007, the highs last year, and now we are breaking above all of that overhead supply. If we're making all-time highs in the UK, I doubt that that's happening in a market environment where S&Ps are crashing. Here's a short-term look at the London FTSE 100, and we are running into last year's highs. So although bigger picture, this looks great, short term, there's resistance here, and that's obvious, and the market needs time to digest that overhead supply. I think it's doing it just fine, and I think we break out. So if you live in the UK or whatever the case may be, I think you get long and strong if we're above last year's highs. Canada, same exact thing. I think we go on to make new all-time highs. Look at it. This is Europe, showing the underperformance of Europe. So while the S&P 500 is the best in the world, right, and Canada and UK aren't as good, but they're getting there, Europe still sucks. This is Europe. Here's the highs in 2000. Notice how the S&P 500 retested those highs back in 07. Europe got nowhere near there, and now with the S&P 500 making all-time highs up here, look at Europe continuing to make lower highs. So until this resolves in one direction or another, Europe is what we consider a hot mess. Here is Europe versus the United States. So here's the S&P 500 making all-time highs, and here's Europe continuing to make lower highs, right? This is a disaster. We don't want to have anything to do with Europe. And then here, if you compare the two, right? So here, we have S&Ps up top, Europe at the bottom. Here's a ratio between Europe and the S&P 500. And notice how it's just a beautiful downtrend. We just took out the late 2014 lows, and I think this is going lower. So if you're allocating a portfolio and you're like, well, we diversify into European stocks or do we stay in America? I think we stay in America. And if you want to put on a pair trade where you're long the US and short Europe, I think it's a home run. Here's emerging markets. This has been the worst market on planet Earth over the last 5 years. Not a secret. Coming down with commodities and everything like that. And this is a ratio of emerging markets relative to the US. And this looks like a breakout to me. So I think we stay long and strong emerging markets, particularly relative to the S&P 500. Within emerging markets, the fact that Latin America is outperforming, I think really suggests to us that there's a ton of risk appetite out there for equities. Because think about it, if emerging markets are the garbage stocks of the world, then Latin America has to be like the bottom of that garbage, right? So if you're seeing money being allocated into the Latin America at a faster rate than in emerging markets, that's even more evidence of risk appetite for equities as an asset class. And this ratio looks like a bottom to me, and I think we rip. And I think that that's great for emerging markets. I think that's great for commodities. I think that's great for emerging market currencies. I think that's great for US stocks that have exposure in materials and industrials and energy. And I think that my friends make fun of me because I look at so many charts and everything like that, but I promise you from the bottom of my heart, the entire process of going through all of these charts makes it impossible for me to miss these themes. If you keep getting punched in the face over and over and over again, eventually it's going to hit you. Hey, emerging markets don't look too bad. All right, so here back to the United States. So here we're looking at technology. Those are the all-time highs in March of 2000, and notice how we're still not there. I think there's a ton of room to fill in technology. And these are all your favorite names: Microsoft, Apple, Cisco, Intel, Google, Facebook. These are all the big technology stocks that Amazon isn't even in that group. So here's a short-term look at technology. This looks like a breakout to me. It's the best performing sector in America from any time horizon that you look at. Sure, in the near term, we've had some, some strength in some other sectors, but in reality, technology has been the leader. And not to mention, technology represents 21% of the entire S&P 500. So if you have the largest sector in America leading the market higher, that's a good thing, right? So here's my favorite technology chart. This is tech relative to the S&P 500 going back to the crash in 2000. So this is tech relative to the rest of the market. So tech peaked in 2000 on its own, as we all know, right? Epic crash. But it peaked relative to the S&P 500 as well. And it has taken 14 years of consolidation, of digesting those horrible losses in that crash, to now breaking out. So if we have the largest sector in America, representing over a fifth of the S&P 500, breaking out of a 14-year base relative to S&Ps, I find it hard to be bearish. So I think we need to look at technology. This was Apple in Stocktoberfest of last year. It had hit our upside objectives, and this was a fade all day. There's been no reason to own Apple since we hit our $130 target, which again was the 161.8% extension of the entire 2012-2013 decline. Very simple math, and it's been a fade ever since, right? So look at it closer. This was Stocktoberfest last year. This 6-month consolidation in Apple resolved to the downside, right? So we now know that where there was more demand than supply at this $120 level-ish, now when that broke, the market is now suggesting that at 120, there are more sellers than buyers. There is more supply than demand at that 120 level. So fight it if you want, but it's a fade. Any strength towards 120, fade all day, and we're playing for a short back to those August lows, back to the low 90s. And then obviously, as we all know, Apple rolled over and got back down to those low 90s. So we cover all of our shorts here, and now it's no longer a problem, right? So after some backing and filling, some consolidation, we broke out above the downtrend line from last year's highs. So this has been a long all day since we were at $100, and I think we're going back to 130. I still like Apple. We want to be buying any and all dips. Here's Apple looking a little bit longer term. I mean, to me, it's clear. Notice how momentum never reached oversold conditions. That's a characteristic of an uptrend, characteristic of a bull market. And for you guys curious as to how I look at momentum, come find me later. But I think this is a long all day. If we're above $100, this is a long to 130. I'd be a buyer of any and all weakness in Apple. Here's Google. I think we're about to break out to all-time highs. If we're above 780, it's a long, and I think we're going up to about 870 in Google. If we're below 780, it's somebody else's problem. But if we're above that, I like it long. Here's Intel. This is probably my favorite of all of them. Look at this major consolidation going back to 2000. We are now just breaking out above that. This is another large cap tech stock that I absolutely love. If we're above 38 bucks, I think you need to own it, and I think we're going into the 50s. Here's a short-term look. So we're still near the overhead supply from late 2014. But again, if we're above that $38 level, I think you got to own Intel. Microsoft, monster. I mean, think about it. Just Apple and Microsoft alone, you're talking about $1 trillion in market cap, breaking out near all-time highs. I mean, that's powerful stuff, guys. So I think if we're long, I think if Microsoft is above those March 2000, late 99 highs, I think we got to be long, and I think we're going to 75 bucks in Microsoft. So, for you math majors out there, if you start to calculate the market cap increasing and figure out how that's going to translate into technology as a sector and the S&P 500, I mean, you're going to come up with some pretty high price targets for the indexes. Here's Microsoft shorter term. So here's Twitter. Everybody wants to talk about it. Compared to anything else in that space, it's one of the worst, obviously. But I think things have potentially changed. And if you really want to be long Twitter, I think you use 17.5 as your level. If we're below 17.5 in Twitter, I think there's zero reason to own it. You stay away. But if we're above 17.5, I think you get long and you take profits at 30. Excuse me? It's down $1. It's not our problem. So here's crude oil. I'm going to give some room to Charlie, so let me just finish up. Here's crude oil. This was last year, still in a downtrend, still a hot mess. No reason to be involved in crude oil, right? This is last Stocktoberfest. Well, things have now changed. And I think that we get long crude oil if we're above 52 bucks, and I think we're going above 60. I want to show you guys some interesting charts if you guys find me. So here's another reason why I like crude oil. So up at the top, we have what I created, an oil countries index, right? So it's an equally weighted index of the Russian MICEX, the Brazilian Bovespa, Canada's TSX, and Australia. Equally weighted, and look how beautiful the correlation is between this oil countries index and crude oil. So we look for divergences and we look for leadership out of the countries that have that energy exposure, and look at what this is doing. We are breaking out of a downtrend that goes back to the 2008 highs. So I think this is a leading indicator for crude oil, and I think we want to own that market. And let me just finish up with gold. People keep asking me about gold. Look at these are the commercial hedgers. So these are the smartest gold traders in the world, and they are net short 300,000 contracts. So the smartest gold traders in the world have their biggest short position ever. So if you think you're smarter than them and you want to buy gold, go for it. I don't think that's a good idea. And silver, same exact thing. They're net short 100,000 contracts. So I think that although structurally, gold and silver, I think, are going a lot higher, I think over the next several months, you want to see these trades unwind and then follow that leadership. By the way, they're super short now. They were historically long in December, right before one of the biggest rallies we've ever seen in this market. So let me just finish up with, I wish I could show these charts, but I want to give Charlie a chance. So just real quick, I provide all of these charts for anybody. And I look at all of the US indexes. As you can see here, you'll notice that everything is both on a weekly and a daily time frame, because we look at the weekly charts for structure, daily charts for tactical positioning. These are all of the international indexes. These are all of the industry groups that we look at in the United States. These are all of the currency markets, all of the interest rates markets, commodities. My precious metals workbook is something I'm really proud of. I have some really cool charts in there. And then our membership is really global. I mean, this is a map of all of the All-Star Charts members from all over the world, and the usual suspects, United States, Canada, Europe, and everything like that. But as you can see, the fact that we look globally into the entire world, we're not just focused on what's happening within our borders. I think people around the world are noticing that, and there's a lot of appetite out there for our work. So if you guys go to allstarcharts.com/Stocktoberfest, we've never done this before, but you go to this website, you get a free month. We usually kind of do like a risk-free something, but Howard is nice enough to invite me here for the 5th time. I haven't been kicked out yet. So guys, take advantage of that, allstarcharts.com/Stocktoberfest, 30-day free trial, doesn't cost nothing. And I hope you enjoy it. So if you guys have any questions, come find me. I'm going to be around, and you guys can play with the entire platform next door.
All right, so we're going to do something a little different this year. This is my 3rd year here, so I want to make the focus today about evidence over opinion, right? So on that theme, let's just get this out of the way. I'm not your guru. You might have heard that. It's a recent Tony Robbins Netflix documentary. I highly recommend it. And Tony Robbins is famous for getting people to get over their fears, getting past their fears. And I want to help you guys get past the fear, and this is something I had a hard time with doing for a long time, is getting past the fear of saying 3 important words. I don't know, right? So I'll go first, right? Where's the S&P going to be at the end of the year? It's one, everyone asks that question. I have no idea, right? The 10-year yields, don't know. Gold, crude oil, are they good investments here? I really don't know. How about a recession next year? Are we going to have a recession next year? A lot of people thought we were going to have it this year. I'm not sure. Is the Fed going to hike rates? A lot of people say they're going to hike in December. That's what the futures market tells us. That changes every day, right? So we're not really sure. They may hike, they might not hike. And what about the election, right? That's the big theme in recent weeks. There's always someone opining about who will win the election and how it's going to impact your portfolio. You should buy these 5 stocks anticipating a Trump win or a Clinton win. I don't know who's going to win. And if we're being honest, we don't know how that's going to impact your portfolio. So 3 important words. Now, why are they so important? What's the value in saying I don't know? Well, Studies have shown, and it seems counterintuitive, right? You would think the more you know, the better. You know, if there's something going on in the news, right? We've had 20 corrections in the S&P since March 2009 of greater than 5%. All of these have different reasons for the correction. You had debt crises in Europe, you had Fed concerns, you had rising dollar, falling oil, you had Ebola. Remember Ebola? That was a good one. And then you had Brexit most recently, right? And all these things in a former life, I would have spent days, weeks, months analyzing all the nuances of these things. How is it going to impact this or that? And now it's freeing to just say, I don't know what's going to be the impact because there's no way to determine a probability based on that. It's just news, it's just noise. So studies have shown that the more people know or think they know, the more confident they are. And confidence in many areas of life is a good thing. In investing, it could be a very bad thing, especially overconfidence. And why is that? Because when we're overconfident, we tend to overtrade. And when we overtrade, we tend to underperform. And an interesting note on that is, men, we're very confident, right? We think we know a lot. We think we know more about investing than women. So what do? We trade more. And the studies have shown, how's the performance of men versus women? Women tend to outperform men because they're less confident, because they don't trade as much. So an interesting thought there. So let's go through the years since 2009, and let's just bust some myths and talk about focusing on evidence over opinion. So back in 2009, worst recession since the Great Depression, right? Earnings are collapsing. I had an argument with a colleague at the time. He was telling me, you can't buy the S&P until earnings recover, right? Earnings drive stock prices. That's what we're told, right? You wanna, in the long run, that's true, right? Earnings go up, the stock market goes up. So you think there's value in it, and everybody talks about earnings every quarter. It's a big topic, and we say, look at the earnings. If they're good, that means it's good for stocks. It's bad, that'll be bad for stocks. But it's not that simple, right? And why is that? Because stocks are a leading indicator of not only the economy, but of earnings. Earnings are a lagging indicator. So as it turns out, if you go back to the 1800 using Shiller data, if you sold the S&P every time earnings went negative on a year-over-year basis, and then got back in when they turned positive, this is what I call the rearview mirror gap. You'd underperform. A 9% buy and hold return goes down to 5%. So be careful when people talk about earnings, right? We've had an earnings recession in the past few years. Stocks hit new all-time highs. That's befuddling a lot of people, but it shouldn't, right? Because the market's looking ahead to the next quarter, which will probably be the first positive quarter we've seen since 2014. 2010, everyone remembers the flash crash, right? May 6, 2010. It looks like a little blip on the chart on the left side there. You'll note that little highlight there. But at the time, it felt like the end of the world, right? The fat finger, there was all different theories. Why did it happen? And the thinking on that day was, there's panic, there's something wrong in the markets, you should sell, right? You should respond to that panic and sell. And if we're looking at it unemotionally, what does the data say? What does the evidence say? Looking at days like that, going back in history, going back to 1970, if you look at these worst days where you have huge declines, 90% downside days, do you see that carrying forward into the future? Well, as it turns out, no, you don't. You actually see above average returns going forward from one day all the way through 1 year. So instead of looking at panic as a reason to sell, I say you should embrace panic and use it as an opportunity. At the very least, you should question people who are telling you to panic because of one down day. Now, 2011, everyone remembers that was the last year. The S&P had a 20% decline. Some people called that a bear market. Some people say no, it didn't hit that on a closing basis. It doesn't matter, right? Those terms, those definitions don't help you at all. I think the most interesting thing in 2011 was the pundits who were saying the stock market decline was evidence, in their view, 100% that the US economy was going into recession, right? We heard this from many, many notable investors in 2011. Now, you didn't have to go back too far, though, in history, if you look back in history, to see many bear markets that didn't turn into recessions, right? 1998, 1987, 76 to 78, you can go back. All of the highlighted, you can't see it in the chart, but all of those years we had 20% declines without a recession in the US. So we have to be very careful of that. There's always a chance. The right side is a chart showing the probability of a recession at any given time. There's always a chance of a recession next year. but it's not usually as high as people would have you believe. So you have to be very careful when people start talking about the stock market and recessions and those types of forecasts. 2012, right? A lot of uncertainty that year. That was the last election year. You're hearing many of the same themes in 2016 that we heard back in 2012, right? It was the most important election every one of our lifetimes. There's going to be a lot of uncertainty in markets, and we're taught uncertainty is bad, right? It's not a good thing. The market doesn't like uncertainty is what we hear. But is that really true, right? Why is there a risk premium in equities to begin with? Why do equities outperform other asset classes over time? It's because there's higher volatility and there's because of uncertainty. So thank God there's uncertainty or we wouldn't have those returns. And if we go back in history and look at how would an investor have performed had they gotten out in every election year going back to the 1920s? Well, not so good. A $10,000 investment and a buy and hold goes into $31 million versus $3 million for someone who avoided all the election years. And why is that? Because the average election year actually has a higher return than the average of a non-election year. So be very careful when people tell you you should sell something because of uncertainty, right? There's always uncertainty, and it's your friend, not your foe. 2013, this was one of my favorites. The rising rates, right? Fear of rising rates. Rates have been falling in the U.S. since early 1980s, and in 2013 they had a substantial rise, right? And there was a lot of talk about how that's going to kill the bull market, right? Was there any evidence behind those calls? No. They just said rates are going to rise, and this whole bull market is fueled on easy money and lower rates. So therefore, if rates rise, then the market must go down. And what happened, as you can see, the red line is the 10-year Treasury, the blue line is the S&P. S&P has its best year since 1997, and interest rates rise substantially during the year. And if we look back historically, was this a surprise or should it have been a surprise? Not so much. If we look at years since 1928, years in which the 10-year yield rose actually outperform years in which the 10-year fell. So it's not that interest rates don't matter. They matter very much. But you have to tell me not only whether they're going to rise or fall, but why they're going to rise or fall. So if interest rates are rising and it's because growth is improving, that could be very good for the stock market. If it's rising and it's because of a high inflation and it's recessionary like 1973, 74, that could be very bad. Same thing on the flip side, right? Interest rates falling can be good, or it can be very bad, as we saw in 2008, if it's associated with a deflationary collapse, right? So 2014, right? King dollar, this was, dollar goes on, it's one of its strongest runs that we've seen in history, pretty much straight up in the back half of the year. And the thinking was, well, along the same lines as, well, the Fed has been very easy and a weaker dollar has been good for the equity market, and therefore a strong dollar will be bad, right? So we should expect the market to fall. And in 2014, the S&P does a double-digit return, and that shouldn't have been surprising if anyone looked at the actual underlying data that shows that the correlation between the dollar index and the S&P is essentially zero going back in time. So it's a coin flip as to whether the stock market's going to rise or fall based on what the dollar's doing. 2015, right? Oil, right? Oil's collapsing, continues to collapse, and again, people are saying the S&P needs higher oil, right, to succeed. And if we look back historically, is that the case? No, again, there's a zero correlation between the S&P 500 and crude historically, and if we go back to 2009 through the end of August, the S&P is up 270%, and crude oil is roughly flat. So the notion that the S&P needs higher oil, right, is just patently false, and you have to just be wary of that. Now, does that mean crude doesn't matter at all? Not at all, right? It does matter if it's influencing the credit markets, and we had some scares earlier in the year, but if you think you can predict where crude is going to be a year from now, and you can tell me what that's going to do to the equity market, I don't think that's the case. 2016. So 2016 is, a lot of these themes have really occurred this year. We've had, a tale of two markets, I've called it this year. One of my favorites is 52-week lows, right? We're told in technical analysis that you should sell 52-week lows. This is a sign of weakness. The market's going to go down, and it sounds good, right? If the stocks are going down, they continue to go down. But if we look historically, that's not the case, right? So if we go back in history and say, what happened to the market going forward every time it hit a new 52-week low? we actually see outperformance going out 1, 3, 5 years, which shouldn't be all that surprising because not every 52-week low is the start of a next bear market, right? And buying low, the buy low, sell high, does tend to work, at the extremes. Now, when I post these articles, there's a whole blog post associated with these concepts. I get a lot of, let's say, pushback from people. They're saying you're hiding behind the data, the evidence. You don't have the guts to make a call, right? You don't have the guts to really put your credibility out there and just say, this is what the market's going to do. And you're right, I don't, right? I don't want to be someone who comes out and says, let's say, sell everything, right? I wouldn't be able to sleep at night if I said that and then, let's say the call was right. Then I have to tell you when to get back in, but we know it wasn't right. So try to think about that when you have people talking about extreme forecasts. What is their objective and what's your objective, right? Their objective is very clear. It's to get attention, right? It gets a ton of attention. Every major media outlet ran with that story. Sell everything. Cataclysm. I mean, that was a great word that they used, right? Things that really, cause you to question, should I sell? Should I give into that fear and sell? And it's our job as investors to ignore those types of calls because they're not based on anything evidence-based. They're just subjective opinions, right? And on that note, so the S&P's up this year. It'll be the 8th consecutive positive year. And every year, we've heard these doomsday calls of the end of the world, and this is a chart of the long volatility ETN, VXX, and you can see it's down, as close to 100% as you can get, since its inception in 2009, and this is what you have to try to avoid, the idea that you're going to be able to time the next big short, right? I love that movie, it's a great movie, but people think that, there's an ability to time that, and it's very, very difficult, right? If you watch the movie, you saw them struggling for years before that trade started to work, right? So you have to think about the cost of making extreme predictions and then acting on that in your portfolio. So what do we do with that, right? So, do we just throw our hands up and say, I don't know, and then just, forget the markets and investing? No, there's power in saying, I don't know. There's power in saying that because it frees your mind then to focus on things that do matter, right? Like asset allocation, which is shown to have, 100% of your portfolio's return is determined by your asset allocation over time. So the best odds for most investors, right, not everyone, most investors, the best odds of success are going to be something very boring, right? Diversification, asset allocation. And it doesn't matter, if you don't know something in the markets, you can still participate, right? And what you'll find is the experts that seem to know a lot of things about where things are going, if you look at their own performance, well, it's probably worse than most people who are just using a diversified asset allocation. That's the truth of the business. It's a hard truth, but it is the truth. So in wrapping up, we all have a decision to make. We could focus on evidence, or we could focus on opinion. We could focus on helping investors control their emotions, or you could try to get investors to react to fear and greed. You can have a plan instead of making a prophecy. You can be an educator instead of an entertainer. So what I'm trying to do is think about the next decade as opposed to the next day. So pundit or professional, the choice is yours. Thanks, everyone.
Good job. Thanks, guys. Thanks, guys.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.